7.4 trillion. That is not a forecast. It is not a future bailout package. That is the amount of US Treasury debt that must be refinanced within a compressed time frame, while interest rates are at levels that your mortgage, credit cards, and rent have already felt very clearly. This figure is not sitting on a spreadsheet in Washington. It is right there in your monthly payments. Every time the Federal Reserve raises or holds interest rates, that number continues to swell. Every time they cut too soon, the dollar leaks purchasing power into your grocery bill. And here is the most important part. Changing the person sitting at the Federal Reserve does not change this number. The weapon has already been fired. It is just moving slowly through the system. Most people still believe the Fed is a control panel, a place where a new chair, a new philosophy, or new political pressure can fix everything. That belief is now the most dangerous illusion of modern finance, because what you are experiencing is not poor management. It is not procrastination. It is not incompetence. It is a system that has crossed the threshold where changing leadership no longer changes the outcome, and that has already started to appear in your life. If the Federal Reserve gets it wrong, we can replace the people. New chair. New voting members. Re-emphasize the mandate. The public treats the Fed like a pilot. If the plane shakes, you replace the pilot, but the plane you are sitting in no longer responds to the controls. For decades, this belief was true because the system still had elasticity. Debt was manageable. Demographics were favorable. Globalization was deflationary. Rates could fall without consequences. Money creation could be reversed later. That era has ended quietly. Mainstream financial media still describes every Fed meeting as a decision point. Will they hike? Will they cut? Will Powell pivot? But those questions assume the Fed has a choice. What they rarely say out loud is that the Fed is now trapped by math, not by ideology. Raising rates stabilizes inflation but blows up debt service costs. Cutting rates stabilizes debt but reignites inflation and erodes the currency. There is no right chairperson for this equation. Replacing the Fed right now is like replacing the captain when the hull has already cracked below the waterline. The delay, the cautious language, the data dependency, none of that is prudence. It is bondage. To understand why the Fed no longer works the way people think, you have to follow the plumbing. Start with government debt. The US does not pay off debt. They roll it over. Old bonds mature. New bonds are issued to replace them. When interest rates were near zero, this was painless. Refinancing $1 trillion at 1% is just background noise. At 4 or 5%, it becomes a structural problem. Every extra percentage point shifts hundreds of billions of dollars a year from taxpayers to bondholders. Now stack the banking system on top. Banks hold treasuries as safe assets. Those assets are only safe if rates are low or if held to maturity. When rates rise fast, bond prices fall. Unrealized losses pile up. That is why liquidity facilities exist, not to save banks from bad behavior, but to prevent forced selling, which would expose insolvency. Now add households to the picture. Credit cards adjust monthly. Auto loans adjust yearly. Home mortgages cause people to be frozen in place. High rates slow spending, yes, but they also trap liquidity. People stop moving, refinancing, or upgrading their lives. The economy isn't cooling down, it is frozen. The Fed's tools were designed for a system that can breathe. This system is holding its breath. And here is the kicker. None of this changes if you swap the Fed chair, because the constraints are structural. This is where people start to get uncomfortable, because the outcome looks like failure, but the behavior looks intentional. The Fed knows that maintaining high rates for long will pressure regional banks, weigh down commercial real estate, increase government interest costs, weaken wage bargaining power. Yet the stance remains tight. Why? Because the alternative is worse. A quick pivot would ignite asset inflation, collapse the credibility of the dollar, signal fiscal dominance, accelerate capital flight. The Fed is not choosing between prosperity or pain. They are choosing where the pain will land. This is not an accident. It is a controlled burn. And controlled burns are never fair. They protect systemically important structures. They sacrifice the periphery. That is why emergency mechanisms appear quietly. Vague language. Deadlines avoided. The Fed is no longer navigating growth. They are managing the speed of the collapse. Most people still believe there is a safety cushion. The Fed will step in, the government will spend, the market will recover. But watch how every exit locks itself. If the Fed cuts aggressively, inflation returns. Real wages decline again. Political backlash escalates. If the government spends more, bond issuance rises. Yields spike. The Fed is forced to absorb the supply, overtly or implicitly. If banks are bailed out, deposits become even more concentrated. Access to credit for the masses tightens further. If the market rallies hard, financial conditions loosen, forcing the Fed to tighten again. Every solution triggers its own counter-reaction. This is the gridlock state of the system. The Fed cannot save the market without breaking the currency. They also cannot save the currency without breaking the market. Changing leadership does not remove this trap. It only changes how the story is told. When the system is frozen, it doesn't collapse evenly. It becomes rigid. Those who access cheap capital early have locked in low rates. They own assets with fixed financing costs. Everyone else is pushed into floating costs. Renters bear inflation every month. Borrowers bear it every day. Savers bear it invisibly. This transfer is not dramatic. It is procedural. Interest flows upward. Costs are normalized. Liquidity becomes selective. No announcement is made. And because no single actor is responsible, accountability is dissolved. That is why the system prefers complexity. It disperses blame while concentrating results. You don't need anyone to tell you what to buy to see the shift. Money is leaving maturity-sensitive assets. It is avoiding leverage. It is demanding yield without volatility. It is parking, not investing. You see it in money market fund balances, in short-term instruments, in the caution of balance sheets. This is not optimism. It is a defensive posture. Capital is not confident. It is waiting, and waiting capital creates its own pressure. There is a variable that most analyses miss. Not inflation, not employment, not GDP. It is the rate of refinancing. The speed at which past low-interest debt is forced to face the reality of high interest rates. This does not happen linearly. It comes in waves. Each wave tests a different layer. Households, banks, local governments, the federal balance sheet. Watch the auctions. Watch the bid-to-cover ratios. Watch who shows up and who doesn't. Because when refinancing is no longer smooth, the Fed's final illusion will vanish. And when that happens, changing the Federal Reserve will finally be understood for what it truly is. A cosmetic action in a system that has already made the core decision. The next question is not what the Fed will do. It is how much longer the system can pretend that a choice still exists. $7.4 trillion. That is not a forecast. It is not a future bailout package. That is the amount of U.S. Treasury debt that must be refinanced within a compressed time frame, while interest rates are at levels that your mortgage, credit cards, and rent have already felt very clearly. This figure is not sitting on a spreadsheet in Washington. It is right there in your monthly payments. Every time the Federal Reserve raises or holds interest rates, that number continues to swell. Every time they cut too soon, the dollar leaks purchasing power into your grocery bill. And here is the most important part. Changing the person sitting at the Federal Reserve does not change this number. The weapon has already been fired. It is just moving slowly through the system. Most people still believe the Fed is a control panel, a place where a new chair, a new philosophy, or new political pressure can fix everything. That belief is now the most dangerous illusion of modern finance, because what you are experiencing is not poor management. It is not procrastination. It is not incompetence. It is a system that has crossed the threshold where changing leadership no longer changes the outcome, and that has already started to appear in your life.